Hi, Mr. Ng. I heard that you wanted us to do a video on our allocated companies. So the company that I was allocated to is Cocoland Limited. Cocoland Limited is like a property company. So give you a quick overview. Cocoland is a member of the Hon Yong Group, and then Hon Yong Group owns Coco Group, followed by Coco Group owning Cocoland Limited, and then divided into the four different countries: Cocoland Singapore, China, Malaysia, and Vietnam. Hong Leong Group is one of the largest conglomerates in Southeast Asia, and Coco Group Limited is a company listed on the main board of the Stock Exchange of Hong Kong Limited. And Coco Limited is part of the Cocoland Limited owned by Hon Yong Group. So providing that is owned by Hon Yong Bank, it has a huge financial support. Next, moving on to the board of directors. Board of directors, the currently one in charge is Mr. Chia Pong Kwak, and yeah, they have award surprisingly. Is a public company listed on the Singapore Exchange and an award winner. Developer whose developments are distinguished by quality, innovative designs and concepts. A major developer headquartered in Singapore's Cocoland has substantial land bank in the embedded markets of Singapore, China, Malaysia and Vietnam, which will continue to build on. So now moving on to the earnings per share. Earnings per share defines the portion of a company's profit allocated to each outstanding share of common stock. Earnings per share serves as an indicator of the company's profitability, and calculating is more accurate to use with the average number of shares outstanding over the reporting term, because the number of shares outstanding can change over time. The EPS is also generally considered to be the single most variable in determining a share's price. And more important aspect of EPS is that it's often ignored in the sense that the capital that is required to generate the earnings in a calculation. For example, two companies can generate the same EPS, but one could do so too with the less equity. The company will be more efficient at using its capital to generate income, and would otherwise be a better company. So for Cocoland, you can see throughout the past 4 years, it's been decreasing. So I can say that the profitability of this company has been declining for this past 4 years. Next will be the net profit margin. Net profit margin is a ratio of profitability calculated as net income divided by revenues. It is a very useful method when comparing companies in similar industries. A higher profit margin indicates a more profitable company, of course, which shows that it has a better control over better control over its cost compared to its competitor. So imagine a company that has a net income of 10 million from sales of 100 million, giving it a profit margin of 10%. So in this case, Cocoland dropped from 18.3% in 2010 and then went back to 6%. So yeah, next, return on equity. Return on equity is the amount of net income returned as a percentage of the shareholders' equity. Return on equity measures a corporation's profitability by revealing how much profit a company generates with the money shareholders have invested. There are several reasons in the formula that the investor use for. First will be the investors wish to see the return on the common equity and to see how much they can obtain from it. Next will be the return on equity, and lastly they want to calculate the change in the return on equity for a period by first using the shareholders' equity figure from the beginning of a period as the denominator to determine the beginning of ROE. Next, it will be the quick ratio. Quick ratio is an indicator of a company's short-term liquidity. The quick ratio measures a company's ability to meet its short-term obligation with its most liquid assets. For this reason, the ratio excludes inventories from current assets. So generally, the formula is that the quick ratio is defined as the formula current assets minus inventories divided by the current liabilities. The quick ratio measures the dollar amount of liquid assets available for each dollar of the current liabilities. So I guess you also know that the quick ratio average number to be better is to be more than 1. So in this case, Copeland has never hit 0.5 or above throughout these 4 years. So you can say that this, for example, let me take the quick ratio in 2013. 2013 is a value of 0.49. So this quick ratio of 0.49 means that Copeland has only 0.49 of liquid assets available to cover each $1 of current liabilities. As what I said just now, the theory makes that the higher the quick ratio, the better the company's liquidity position. For the quick ratio is more, how to say, basically it measures how well a company is able to cope with its liabilities. Next will be the price earning ratio. The price earning ratio is a valuation ratio of a company's current share price, I think compared to its per share earnings. I'm using this because I want to see if I can expect a higher earnings growth in the future compared to companies with a lower price earning. However, the P/E ratio doesn't tell us the whole story by itself. It's usually more useful to compare the P/E ratio of one company to the other company in the same industry. For example, Capellan and CapitaLand. So, for instance, the price earning ratio will be $57.40. Yeah. So the P/E ratio for it will be 14 with 7.14 multiplied by a period of 1 year. Yeah, that's all. Then next will be the price to book. Price to book ratio is a ratio used to compare a stock value to its book value. Is calculated by dividing the current closing price of the stock by the latest quarter's book value per share. So a lower P/B ratio could mean that the stock is undervalued. However, it could also mean that something is fundamentally wrong with the company. As with most ratios, be aware that this varies by industry. This specific ratio also gives you some idea of whether you are paying too much for what will be left if the company went bankrupt. So for this instance, 0.86, I think I'll be getting 86% back, or worse than that, because like I say just now, it could be a lower P/B ratio could mean that the stock is undervalued. Next, cash flow balance. Cash flow balance measures the financial health of the company, measuring the cash inflows and outflows caused by core business operations, and is calculated by making certain adjustments to net income by adding or subtracting the differences in revenue, expenses, and credit transactions. See, for the past 4 years, it's been up and down. For 2010, it's been 72 million. Then next year was 177 million. And then boom, it went down to 500, negative 536 million, and then it went back up by 62 million. Um, you might think that it may due to investing operations in 2012, but I've done research that in 2012 Cocoland hasn't been doing any investments. So I would say that it will be a company downfall for a short period of time. In conclusion, the company can use Cocoland can use a cash flow statement to predict the future cash flow, which helps with methods in budgeting. So for us investors, cash flow reflects the company's financial health. Basically, the more cash available for business operations, the better. However, sometimes negative cash flow results from a company's growth strategy, which I say just now that it does not that Coconut has not been doing any investing. So next, the debt ratio is measures the extent of a company's or consumer leverage. The debt ratio is defined as the ratio of a total debt to a total assets expressed in percentage and can be interpreted as the proportion of a company's assets that are financed by debt. The higher of this ratio, the more leverage the company and the greater its financial risk. So in this case, from Cocoland 2010, it went up to 0.7 from 0.6 from an original value of 0.63. Just shows that Cocoland is quite risky to invest for now. So now going to the return on assets, the last one. The ROA tells you how profitable a company is relative to its total asset. Also gives a general idea on to how efficient management is at using its asset to generate earnings. The return on assets tells me what earnings were generated from invested capital, and in this case, it's just disappointing because it went down from 2.3% to 0.5%. So this just from what I have said, there's many good and bad views. So now moving on to the news to support my statement. Cocoland queried on price spike. Okay, now you see the price on the stock exchange is currently the highest, like what is stated in the news. So I think it's not advisable to buy for fear of a downfall. Then is next is the Cocoland Malaysia surges on privatization talk. Yeah, it also says that the stock price has jumped more than 50% amid enormous trading volumes. So now, Cocoland stock prices have now cleaned the 50% upside mark. Might have had to do with two developments. Then lastly is that the Cocoland stretched to multi-year high. Yeah. So these three news all supports that it's being too high to invest in now. So yeah, the competitors are also fighting. Like the two Singapore-based companies, CapitaLand Limited and Capital and the other foreign companies and Singapore-based companies. So should we invest? My answer will be no, because it's just that the stock price is too high, and even if you insist on investing, I would suggest to sell short because the prices may go down because it's all year highest, and we may profit from selling short instead of buying and holding long. So yeah, I think that's all for my presentation. Anything more to add is that despite of what I said for Cocoland, the positive and the negative view, it doesn't show that it's worth investing. Because maybe I'm judging based on the market price of this particular stock. So that's all. Thank you.